I'm very pleased to introduce our next speaker, Ken Singleton, the Adams Distinguished Professor of Management at Stanford University. He really needs no introduction. Ken's name is synonymous with financial economics. He's a leading expert in the area of financial risks and their impact on economic decision-making. He literally wrote the book on credit risk. I did write down all the finance and economics journals that he's published in, but in the interest of time, I'll summarize it by saying all of them, every single one. So we're really excited to have him with us today, and he's going to discuss learning in bond markets. So without further ado, I'll turn it over to Ken.
Good. Thank you. Thank you for having me. I'm going to roam. Just easier for me. I'll turn around and look and see what I'm talking about occasionally. It's good to see some familiar faces. I've been away from accounting for a long time. I'm thrilled that Mary's accepted as youth here, since I actually was on her dissertation committee. And that pretty much ends my understanding of accounting. So I'm going to talk about learning, and actually it's going to fit in really well with a lot of the discussion this morning, and I'm going to show you some results that are going to turn sort of some of the observations and some of the confidence that you might have taken away from this morning's conversation a bit on its head. And if time permits at the end, I will ask you to encourage you, put it this way, to think about some questions related to by what mechanisms is accounting information really valuable to market participants, and see whether or not it gets us to pause a little bit and think about what it might ultimately mean in terms of price determination. But right now, I'm going to talk about learning. I'm going to talk about it in a fairly structured finance model. So it's going to be pretty much a finance talk, but I will periodically be relating it back to observations from this morning, and I'll certainly be relating it to the macroeconomy, which is part of the theme of this conference. This is written with a couple of former PhD students at Stanford. Let's see. How does it? There we go. Okay, so there's one of the things about bond markets that make them kind of fun, as contrasted with equity markets, which many of you I know study, is that in bond markets, excess returns really are predictable, and they're predictable with fairly high R-squareds, and there are a lot of reasons they're predictable. They're related to a lot of information that we collect out there, including a lot of macro information. But almost all of that evidence is constructed by running regressions, full sample regressions. We take a realized excess return, a set of potential explanatory variables, we project it full sample, we see we have R-squared 20, 30, 40, 50% sometimes, significant coefficients, and we say, look, there's time variation in excess returns. But of course, it'd be unreasonable to attribute those excess returns to any market participant, because at any point in time, they don't have the advantage of the full sample. So what I'm going to talk about, I can get this to be.
Pushing down moves you forward.
That's what I'm trying to do. Okay. So you tell me which one I'm supposed to do. Is it in present? Yeah. It's a PDF. There we go.
And bottom will move you forward.
There we go. Now I'm rolling. Okay, thank you. So what I'm going to do is think about a real-time learning problem. How would someone endowed with, it might seem like a reasonably sophisticated model, but it really isn't, as I'll try to argue in a minute, some 30 years ago, have learned about risk premiums in bond markets over the subsequent 30 years? What would they have been learning about? Which parameters would they have been changing? And what information would have been relevant for them? And then along the way, I'll ask the question, how would my econometrician that I'm going to drop in the bond market 30 years ago, how would they have fared compared to professional forecasts, a theme that came up early this morning in terms of the reliability or accuracy of their forecasts. Okay, so I'm going to have this agent learning. They're going to recognize that the world is not simple, that we see structural change, we see changes in policy, so they can imagine that sort of key parameters in the economy are changing over time. And then I'm going to actually go out a little bit further on a limb, and I'm going to ask the question about whether or not this person looking at the market and thinking about forecasting should be paying any attention to the degree of confusion in the market about where the economy is going. Something that we often ignore, but we always see around us. Just talk to your friends about where we're going or where we've been over the next few years, and you'll probably get as many opinions as you have friends around you. Okay, so there's and that varies over time about the degree of that confusion. So that's going to play a big role in the second part of my talk. So let me motivate the exercise with a simple regression. I'm going to compare two different models of the risk premium. One, I'm going to assume that expected excess returns on bonds, a notation there is an end period, say an end-month bond, and a horizon of H. And I'm going to assume for now that we're going to believe that excess returns move around with the shape of the yield curve. So I'm going to look at the principal components of bond yields, level, slope, and curvature as predictive variables for how excess returns are moving around. And I'm going to do two things. I'm going to do a full sample estimation and then calculate the fitted expected excess returns from this regression. And the other thing I'm going to do is a rolling regression. I'm going to roll through the sample, doing least squares, adding more data every period and updating forecasts. These are going to converge to each other at the end, because at the end I'll have full sample in both cases. Okay? And then I'm going to compare the implied excess returns. The rolling regression is a very naive form of learning. The full sample is most of the time what we do when we're studying excess returns in bond markets. And this is a plot of the difference between these two in percent excess returns. You can see the numbers get large. They disagree up to 4 percentage points on an annualized basis. They fluctuate over time with the stage of the business cycle in terms of the degree to which they agree or disagree, this full sample versus a learning model. So it just gives us a hint that, oh, and the other thing you'll notice is that the convergence here is very slow. These two things have to be equal at the end, but it doesn't happen halfway through the sample. It happens right at the end. So if there's learning going on, in some sense, it's slow converging to the full sample results. So you can also make a few other quick inferences from this. You can see that on average, the econometrician's full sample estimate is higher than what someone learning would actually have perceived in the market. They would have thought the risk premium were lower. What you can't see from this picture is that the learning agent would have been much more volatile in changing their views over time than the full sample estimates. And that's kind of buried in this picture. But it's a hint that learning might really matter. And that's what I want to talk about. So if people are learning in bond markets, what are they learning about? Well, we could ask that actually 100 different ways. But as a financial modeler, there are a lot of different parameters out there we work with. There's the parameters that govern the evolution over time of the risk factors in the economy that the learning agent thinks are important. There are the parameters that govern the pricing distribution that people on trading desks use to actually price these securities. I'm going to differentiate between those two distributions. And then, of course, there's also the question of what they might be conditioning on as they learn. In the literature, the way we often model a learning problem for an agent is we imagine there's some risk factor out there that they don't observe, and they get a signal, a private signal on that. And then they're solving a filtering problem, learning over time about either what that unobserved state is or possibly some parameters of its distribution. In a bond market setting, the unobserved state of the economy, like we don't really see output growth, in some sense is not really the most relevant thing, because one of the characteristics of bond markets is that the first 3 or 4 principal components explain virtually all the variation in bond yields. And we observe the principal components. So we pretty much know the relevant risk factors, at least in a financy sense. We're not taking them back to the primitives of the underlying economy. We know the underlying risk factors for purposes of thinking about forecasting. So that's really not the issue. And I'm going to assume that those are the relevant states for my agent learning. What they don't know and what everybody has to learn about is where these risk factors are going to go. What's the level or slope of the yield curve going to be in a year from now? And we don't know, and we probably have differing opinions about that. And that's going to be the spirit of the learning problem. I'm going to have what's going to turn out to be a Bayesian agent. My agent's going to be Bayesian, learning over time, but they're going to be following what's going to end up being a pretty simple rule, as I'll show in a minute when I get into a little bit more detail. Okay, so I got to explain the nature of the learning problem and how I'm going to set up the modeling. So this may sound crazy, but I'll try to argue that it actually turns out in the end to be pretty close to what people were doing 30 years ago. I'm going to take an arbitrage-free dynamic term structure model like we work with now routinely in financial modeling. And I've got my MATLAB code. It's really fast. It computes really quickly. And I'm going to endow an agent 30 years ago with my model and ask how would they have learned in the market. I'll argue in a few minutes that actually they could have really have done this 30 years ago. But right now it's going to sound like that's kind of impossible. And I'm going to then ask how this agent learns over time. So the agent is actually pricing formally under no arbitrage, the presumption of no arbitrage. And the way to think about it is we have the price today of an N, that should be an N period zero coupon bond, M period zero coupon bond rather, that's okay. And how do we think about pricing? Well, we take the value of the security next period, we discount it by our stochastic discount factor in an economic model, agent's marginal rate of substitution for discounting future payoffs back to the present if they're risk averse. And that gives us today's price. And what we do in finance is to try to make it simpler, certainly what banks do on trading desks, is that they don't like working with stochastic discount factors because stochastic discount factors and preferences are hard to model. And so they want to get to a distribution that makes the calculation much simpler. So they combine the discount factor with the actual historical distribution of the state of the risk factors, and they call that the risk-neutral distribution. And we get this really nice result that if this is our density function here, by which we're computing expectations, then we can price the bond as simply the present value of its payoff, the expected present value of its payoff. Okay? So we don't have to worry about preferences. If, in fact, we can come up with a distribution by which a hypothetical risk-neutral agent would be doing the pricing. So if I'm going to endow my agent 30 years ago with this pricing model, I have to decide what they're learning about. Do they know the pricing distribution? Do they know the historical distribution? Or do they know neither? Well, intuitively, I think it makes sense to say they know the pricing distribution because this is what banks do all day long. They take the cross-section of all the prices in the bond market and they calibrate a reasonably accurate pricing model to the cross-sectional bonds today, and they use that model for hedging and they use that model for pricing relatively illiquid bonds that are trading off the curve on that day. And it's essentially just a curve fitting exercise, or over time, it's essentially just a regression exercise. So I'm going to assume that my agent knows this pricing distribution. They don't have to figure this out. They actually know it. What they don't know, actually I can go down a slide. What they don't know is they don't know the historical distribution. So let me put this in sort of simpler language. They know that the short rate is related to the factors in the economy, in this case the principal components of bond yields. And if I go back a slide or two, they know the principal components. And it turns out that under a large class of models, that bond yields end up being linear functions of the risk factors, so-called affine family of term structure models. But think of any equity model you've worked with. Factor models are everywhere. Returns are related to a set of factors which are frequently returns in the market. There are a lot of dynamic term structure models that imply that bond yields are linear functions of the risk factors. And the coefficients in these factors depend only on the pricing distribution. They don't depend on the historical distribution, on the data generating process. So the reason that's convenient is that if I know the risk factors and I observe bond yields, I can just run regressions and I can estimate these loadings. And I can figure them out. Actually, I can figure it out by running cross-sectional regressions and reverse engineer the risk-neutral distribution. And there's a whole bunch of ways to show that that works. But basically, it's a reasonable assumption to think that everybody knows the pricing distribution. Now, for that to be true, and if there are a lot of heterogeneous people out there, then their preferences and their subjective views about where the future is going must interact in such a way that even though we disagree, we have different preferences and we disagree about the future, we all agree on the pricing distribution. And that's what I'm going to be assuming. Now, it might be going through your mind that, well, wait a minute, how could everybody agree? Because I just tried to argue earlier that lots of people disagree. Well, first of all, people disagree. So here's a measure of disagreement in the bond market. What I did was I took 30, 40 professional forecasters of bond yields, and I looked at the cross-section of them, and I ordered them. Those people think rates are going to go up high. Those who think rates are going to stay the same or fall. I took the top decile and the bottom decile, and the difference between them about where they thought rates were going to go as a measure of disagreement. And you can see for both the 7-year bond and the 2-year bond, the 2 is in blue, the 7 is in red, there is disagreement. We're looking at 140, 180, 160 basis points of disagreement as to where rates are going to go. The same rate over the same horizon, they're 140 basis points apart. Furthermore, disagreement isn't fixed. It moves over time, and it moves with the business cycle, the blue or the shaded NBER recessions. So you get more disagreement around business cycle times, and it moves around over time. You get less disagreement in good times, so to speak. Well, if there's this much disagreement in the market, how could people possibly agree on a pricing distribution? Well, in an earlier life, I sat on a trading desk, and actually it's completely intuitive to me that people agree on the pricing distribution because virtually every major bank is calibrating the same pricing model to the bond market and doing the same risk management strategies and observing market prices. But we could still ask if these people have such wildly different views about where interest rates are going, could they possibly agree on the pricing distribution? And we can check that. And here's a really simple way of checking that. If they believe that yields follow a factor model, and in an arbitrage-free setting, the loadings, the risk, the hedge ratios, the weights on those factors, they depend only on the parameters of the pricing distribution. Then if I replace actual yields and actual factors, which are principal components, by the forecasts of these professionals, they should satisfy the same factor structure. Just shift the factor model a period ahead, take expectations through, and I get expected yield is linear in expected factor. So I took the top decile, the next decile, et cetera, of these forecasts, and I ran regressions to see whether or not the loadings look similar across these people with wildly disparate views. And they're on top of each other. Those red lines are the results for the 10 different deciles of forecasters, from the most optimistic to the most pessimistic. That's for the level of the yield curve. That's for the slope of the yield curve. They're virtually identical. So they can have completely different views about where interest rates are going, and they could think that interest rates follow exactly the same factor model. And that's what this is data. This is what the data is telling us of actual forecasters historically from the bond market. So I'm going to assume they agree on the risk-neutral distribution. And as I say, there's kind of a conceptual reason for thinking that's plausible. Okay, so what are they learning about? So they agree on the factor model. They agree basically on the pricing model. They disagree on where interest rates are going to go. That is, they disagree on where the level, slope, and the curvature are going to be a year from now. And that, of course, implies disagreement about where individual yields will be. And so I'm going to take an agent, my hypothetical agent, who I'm going to drop in the market, and I'm going to have them come in with priors that these parameters are shifting over time. And they're going to be learning about these parameters. And they're going to do that in a sort of Bayesian way. They're going to be assuming, for simplicity here, that these parameters are essentially following a random walk. That gives me permanent shifts in the parameters. It's not like they move and then mean revert back, but they're shifting around in permanent ways. And then I'm going to go through and calculate within a dynamic term structure model under the assumption that the state is following an autoregressive process. I'm going to have them do Bayesian learning. It's not a vector autoregression unconstrained because it's a full arbitrage-free pricing model that I haven't laid out all the details for you, mostly in the interest of time, but it's all in the paper. And it's going to turn out in this model, amazingly enough, because they know the risk-neutral, the pricing distribution, that Bayesian learning simplifies down to constant gain learning. And so constant gain learning, for those of you who haven't followed the learning literature, is very much related to what the team up here was talking about a few minutes ago. And that is, when you look at past history and you're rolling through time and learning, you give more weight to the recent past, and you downweight the far in the past. And why would you do that? Because it's natural to do that when you think the economy's changing on you. You overweight the more recent period relative to the distant past. That emerges naturally as the optimal Bayesian learning strategy in the context of this model. So they're Bayesian, but they're really constant gain, and they could have really just done this mostly, almost, with regressions 30 years ago. It's a little bit more sophisticated than that. So what happens? What happens when you implement this model and set it rolling? Well, I'm going to now go give you lots of tables and lots of pictures that show you what happens when my agent's learning over time, recognizing that there's some structural change, and following this Bayesian/constant gain learning rule. I'm going to compare it to a random walk. That's a nice standard. Every yield is just following a random walk. The best forecast of the future yield is today's yield. Reference point. This is the consensus, the median forecast of the blue chip financial professionals. That was in the data this morning, the blue chip forecasts. So I'm using the forecast not of output growth, not of inflation, I will do that later, of interest rates. Okay? And then I have two forecasts. This version without the CG under it is my agent. And my agent in the market, she's learning only from past interest rates. All she's doing is looking, this is important, all she's doing is looking at the past level, slope, and curvature in interest rates. I live in the bond market, all I see are daily, weekly interest rates, that's all I look at. Collecting macro data is too much trouble, it's only available quarterly, it's measured with noise, we learned a lot of that this morning. Let's keep it simple and only look at the bond market. Okay, so pretty naive learning. And in one case, without a subscript, it's rolling least squares, just recursive least squares. And with that, it's constant gain. I'm downweighting the past. That's a more sophisticated version that recognizes the possibility of structural change. So, first observation that contradicts the evidence this morning. We're looking at different forecasts. We're looking at different circumstances. We can get different results. So it's not a logical inconsistency, but it's a striking contrast. My agent, who's learning completely in real time, going through history, substantially outperforms the professionals. This is over a quarter. It'll be even worse over a year, you'll see in a few minutes. So a sophisticated vector autoregression, a dynamic term structure model, which is essentially a constrained VAR, but put within a learning setting where you're updating the parameters over time, downweighting the past, and doing that in this kind of optimal rolling way, substantially outperforms the professionals. Professionals had it wrong apparently a fair amount of the time. This is to say over 3 months. You can see that particularly as you go out to the longer end of the curve, 3 years, 5 years, 7 years, when you're forecasting bond yields, you do much better using the model. The model does about the same as a random walk. And I'll draw a contrast of that later on. So the point of this paper is not to argue the professionals had it wrong, but since we have reached that observation, it's interesting to ask, why did the professionals have it wrong, or when did they have it wrong? And there's, again, a really striking pattern. If you, the blue line is the forecast of the excess returns on a 10-year bond over a 1-year horizon. So 1-year holding period return. It's a 10-year bond, and I'm forecasting a year ahead. The red line is the counterpart for the blue chip financials. This is their consensus forecast of where the 10-year is going to be a year from now. And the dotted black line, it's hard to read, is the slope of the yield curve, the long end minus the short end. So what I would highlight for you is that as you come out of recessions, so in this period here, and this period here, in this period here, notice that there's an enormous gap between what my agent thinks the excess return in the bond market should be and what the blue chip forecasters think the excess return is. Systematically after every recession. So what's happening? Well, think about the recent financial crisis. If you go back to 2013, 14, thereabouts, you could not look at Bloomberg News or almost any other business-oriented newspaper without there being some editorial article that said, bondholders are going to get creamed. Get out of bonds or you are crazy. You're going to get creamed. And that refrain went on and on and on. And if you stayed in bond markets, you did really well. And that's exactly what's happening here. What's happening is the professionals are saying, get out of bonds. And in particular, that we're coming out of recessions and the long bond yield is going to rise really quickly. And if you're holding long bonds, you're going to get creamed. And it didn't happen. And it didn't happen not only in the last, coming out of this last big financial crisis, it didn't happen in the previous 2 recessions either. But that's what they were saying. And the agent who's learning with a vector autoregression is actually, again, a dynamic term structure model. There's constraints across the market prices of risk, so it's an over-identified model. But the learning agent, by rolling through time and conditioning on history, is being told to stay in bonds. So here's an example. You go here coming out of the recession in 2010, and the excess returns are all looking positive. Stay in bonds, stay in bonds, stay in bonds. Then, by the time we get to 14, when rates start to move a little bit, then we start seeing convergence and they come back down and they're getting closer to each other again. So the professionals were systematically wrong, always expecting long bonds to rise more quickly. And yeah.
How much more power do you think the first component is compared to just the term spread?
I'm sorry, what's that?
So the black dash line is the term spread,
Yes,
basically?
yes.
Do you think that's the first principal component adding much more than that?
So that is actually the slope of the curve, which would be the second principal component. And it's a good question. The variation in bond yields is driven primarily by the first PC by definition. But actually risk premia are driven in bond markets to a very significant degree by the slope of the yield curve. And often people try to associate that with changes in monetary policy. And so that's that correlation is kind of particularly evident in some of these later periods, but it's also intriguing that, that it's when curves are really steep that we get these very high risk premium. Okay, so in the interest of trying to get through and say a few more things before I open it up if there are any comments or questions, let me say a little bit about my agent now wakes up one morning and says, you know, everybody seems to be disagreeing about where we're going. I wonder if their disagreement is kind of informative about where prices might go. Why might that be true? Well, my intuition tells me that actually we can sort of we can sort of go to the economics literature here on this. If you write down models where lots of people disagree, they have private signals about what's going on with the economy, and you work out the equilibrium bond prices, what you find is that there are sort of three components. There's the piece that would have arrived in a classical Lucas-style representative agent model. There's a piece that represents consensus beliefs in a world where everybody disagrees, the average beliefs. And then there's a term that represents disagreement. And disagreement shows up in the bond prices. Now, the weakness, in my view, of the literature right now is it shows up too much. It says that everybody's private signal shows up in the bond market, so we essentially need an infinite factor model to explain bond yields, and that they're not that complicated. Low-dimensional factor models seem to work pretty well, but it does suggest that disagreement, speculative demand, this last term, these omegas, the size rather, are the degree of disagreement among the agents weighted by their wealth, their importance in the market. That's what comes out in an equilibrium model. So these models suggest disagreement should show up in bond markets directly. They maybe overcomplicate the nature of bond markets that we might see, but they hint at the possibility that if it shows up in bond markets, then me as a learner, I should be conditioning on that disagreement if I want to forecast the future. So does it help? Does it matter? And the answer turns out to be yes. First thing I would note is that if I look at disagreement and I correlate it with risk factors, the principal components, I get really high R-squareds. These are just contemporaneous regressions. In other words, disagreement does seem to be a priced risk in the market. Disagreement is also highly predictive for future bond yields or excess returns on bonds. This is disagreement about the 2-year. This is disagreement about the 7. These are the principal components. You see lots of big T statistics here looking across, and you also see pretty high R-squareds. So it's informative. This is just full sample regression, but it's informative about the future. So what happens when I condition on disagreement as well? Well, I get an improved performance. So this is the model with looking at both conditioning on history of yields and disagreement. And you can see I get a big pickup in forecasting ability. These are root mean squared forecast errors. So I want them small. I do much better than the model without disagreement at long horizons. And I do substantially better than the professionals. I mean, we're not even in the same ballpark out here. I've got a 70 basis point root mean squared error for my model, and the professionals are at 100. Okay, so these are huge differences in forecast accuracy. Coming out of recessions, I'm more accurate by 200 to 300 basis points than the professionals are about where yields are going to be. Okay, all ex ante, all real-time learning. So where does disagreement matter? How is it helpful? Actually, it relates to some of the conversation this morning. They set me up perfectly. When you look at the errors from forecasting realized returns from my model, take 2 of my agents, one who conditions on disagreement and one who ignores disagreement. Otherwise, the same agent learning through time. By conditioning the solid line, conditioning on disagreement, the H's, you see typically the blue line is closer to 0. That means I'm out forecasting the agent who doesn't condition on disagreement. And the big improvements come at turning points. At turning points. When rates are turning, when there's confusion in the market, I out forecast by actually taking into account the confusion in the market. So that means, translated kind of simply, that confusion in the market shows up in prices. It materially affects prices, and if I condition on that, I outperform in forecasting. Okay? How does it show up? It turns out, I don't have a slide on this, I'll just say it verbally. It turns out that there's two ways it could help. One is, think of vector autoregression. Think of a regression I'm forecasting with. Maybe I should put the h's in as additional explanatory variables, additional conditioning variables. And my R-squareds would go up, my fit would go up. Okay? That's a direct effect. There's another way it can matter. I think that the principal components matter for understanding the future, but I don't know what weight to put on them. And as I learn through time, I'm constantly updating the weights I put on level, on slope, etc., in explaining the risk premium. So my parameters move around, and they depend on the amount of disagreement. It turns out almost all of the impact of disagreement is through the parameter adjustment. It's a nonlinear effect in I change the way I weight the future based on the amount of disagreement in the market today. It's not so much a direct effect. The exceptions turn out to be flight to quality periods, and disagreement does matter then. So it's kind of, and so it's interesting. Okay, so disagreement matters. It has a direct effect on prices. It affects prices primarily because we're sitting there, we're learning, and disagreement tells me something about how the current state of the interest rates will impact the future. Why does disagreement matter? Well, one natural conjecture is that disagreement in the bond market reflects disagreement about the economy. So it's just a proxy. I've got a nice proxy for macroeconomic uncertainty. We heard a lot about that in the earlier sessions today. So we can check that. We can set up a learning model where my agent doesn't learn on disagreement, but learns based on the macroeconomy. They condition on output growth, they put condition on inflation. Actually, they can go more than that. They can condition on disagreement about where output's going to go, or disagreement about where inflation's going to go. And maybe if I do that, then this disagreement about interest rates just kind of washes out. Doesn't matter anymore. That's not what happens. Here's my model, condition on disagreement, my agent, and these are these root mean squared forecasts of expected excess returns on a 10-year bond. And if I start conditioning on macroeconomic information, I do worse. And if I condition on disagreement about macroeconomic information, I do even worse. If I have another slide that kind of shows this more clearly. Depends on the sample period. But basically, conditioning on macroeconomic information doesn't help forecast relative to conditioning on disagreement. So it's not a proxy for the state of the macroeconomy. And if I condition on the disagreement about the macroeconomy itself, that also doesn't seem to drive out my variables. I typically do worse. If I put them in, I just get overfitting. The whole forecast deteriorates because this is real-time forecasting. I've also compared the results to whether, or looked at whether if I use Nick Bloom's measures of economic uncertainty, whether that drives out disagreement as a predictor. It does not. My disagreement measures are not very correlated with Nick Bloom's measure of uncertainty. There's something about disagreement, it seems, distinct from the macroeconomy that is showing up in bond markets, is informative, and is related, I presume, to the trading process. And so I'll leave you then with the question: when we're gathering information, we're releasing information, how is it being processed by agents? And how does it end up being impounded in prices? And is there something about the trading process itself and the agglomeration of beliefs that ends up affecting prices in ways distinct than what we might be thinking by just thinking that there's a direct nice, simple mapping from underlying economic fundamentals to prices. This evidence suggests that there's probably more to be explored around those lines. So I'll be happy to take any questions. Yes?
Could you give some more color on the professional forecasters? Because I think you push them a little bit down. Because are these analysts, and do they have an incentive to give the right predictions? Or maybe you should look at fund managers who really put their money where their mouth is and maybe infer professional forecasts from active managers.
Right. So that's a good question. So I haven't systematically explored this, but let me again tie back to this morning a little bit. You know, my reading of the literature is that I think we learned it's true of output. I know it's true of inflation. The professional forecasts of inflation are pretty good forecasts. We've built lots of time series models of inflation, and when we end up comparing it to what the consensus blue chip forecasts, they're similar, or the blue chip does a little bit better than a lot of our standard time series models. Now, a lot of those are full sample estimates of models, and then you look at them. Here we have these rolling estimates. And so here I'm looking at bond market forecasts, not the macro. And an interesting question is, you know, what are the incentives of the people releasing these forecasts? And I could imagine loss functions by some of these economists at the professional financial institutions are being polled here, thinking that I have a real asymmetric loss function. If my clients stay in bonds and get creamed, I'm going to hear about that. If they get out of bonds and lose a few basis points of return, and by the way, if the economy's picking up and stock markets do well, it's going to get all lost in the shuffle, and I'll be fine. And so I'm going to always err coming out of recessions and getting them out of bonds. That's a possibility, in which case we're just seeing that loss function reflected here, and they're really bad forecasters coming out of recessions. And the incentives might be very different for macro forecasts.
So in the equity market, we talk about disagreement and flowing through to prices because of short selling restrictions.
Yes.
Right. So is your evidence sort of consistent with this, that it's not symmetric?
You know, it doesn't seem to be the same story. I think short sale constraints in the Treasury market are not as material, probably. What the evidence appears to suggest is that I'll answer a slightly different question that I think is still informative. It seems to suggest that in periods when there's a lot of disagreement, you might ask, if the loadings on the principal components are changing over time, how are they changing? And they're changing in the following way, which I now think is kind of intuitive. When disagreement is high, the impact of a shock to the level of interest rates on all future interest rates is relatively muted. And one way to think about that is that when disagreement's high, news gets translated into lots of trading activity and relatively limited price pressure effects. On the other hand, when disagreement is low, when there's more consensus, and we get hit by a surprise, there's not a lot of scope for trading, and it's got to show up in a lot of price pressure because we're all shocked that we all move the same way. And that's exactly what the underlying patterns seem to suggest when you look into it more deeply as to what's going on here. Yeah.
So, you know, this is really interesting, especially for this audience, because I think, you know, accounting has tended to lag finance, and so sort of exposing us to predicting actually bond returns is something that we haven't spent much time at all. I think the maximum we've, you know, spent time on is, say, predicting equity market returns.
More on the equity side, yeah.
So 2 questions. So the first is, have you seen accounting data sort of playing a role in any of this so far? And if not, then do you sort of perceive that as an opportunity for this group?
I haven't seen it. Where I think I could imagine it being relevant. There is evidence. It's still being disputed in the macro finance literature about the degree to which macro information has predictive power over and above the PCs themselves. But bear in mind the PCs are just interest rates, so it's just they don't tell you what's going on below there. And so looking at accounting information would be relevant. There is some evidence that balance sheet information starts to matter when you're thinking about credit spreads, and that would naturally be related to what's going on in the treasury market through flights to quality, et cetera. So I haven't, but this is maybe my lack of familiarity, seen systematic studies of looking at accounting type information. My conjecture would be that it'd be informative, and I probably would start by thinking about credit spreads. I've done work on credit spreads where you look at the survey data on willingness of bank loan officers to extend loans, which is related to the tightness in lending markets, which is going to be related to some of the studies we heard about this morning about default and credit spreads on bonds, and those things really have predictive power for spread. So I would conjecture it will show up there. In fact, that's what I was thinking this morning in some of these studies, that some of those constructions should be used in some predictive regressions. That could be a good idea. Thank you.